We do have that breaking news right now. Let's get straight to Rick Santelli for more on that. Rick, take it away.
Yes, this is our June read on CPI, the consumer price inflationary guide, and it is a little warmer than expected on year over year, but headline looks good, up 0.3 as expected. That does follow up 0.1. Up 0.3 would be the second warmest of the year. January was the warmest at up 0.5%. This is as expected, but 0.2 hotter than the rearview mirror. If we strip out food and energy, comes in 1/10 cooler than expectations, up 0.2. We were expecting up 3, and the rearview mirror was up 1/10. Up 0.2 equals where we were in April. To find a higher number, you're going once again back to January, the high watermark for the year, up 0.4. Now, let's go year over year. Year over year headline, this includes food and energy, is up 2.7. That's 1/10 hotter than we were expecting. It's 0.3 hotter than our last look at 2.4. And how does it comp? 2.7 will be the highest read since February. February was 2.8. January is 3.0. So even though it's less than it was at the beginning of the year, it did warm up just a bit. And finally, if we go year over year ex food and energy, arguably, in my opinion, one of the most important numbers, it comes in at 2.9, exactly as expected. But it is 1/10 hotter than the rearview mirror, which was 2.8. 2.9, well, it would be the warmest read since February once again. You had January and February 3.3 and 3.1 respectively. So even though we have made progress from the beginning of the year when numbers were higher, we do see a little bump on the year over year. Maybe the best news is the monthly core number up 0.2. It certainly seems as though the market was expecting this or worse because interest rates initially moved lower. We're basically unchanged pre-number. 10-year note now hovering at 440 actually is less. We were around 441, 442 before the number. If you look at what's going on with the yield curve, we see that the short rates are virtually unchanged. Long rates are moving down a little more aggressively, and that would make sense if the inflation data is less than the worst case scenario, the long end reflecting that. And, of course, we want to pay very close attention to the yield curve at this point because it really has been about whether it's steepening or flattening. A lot has to do with the short maturities and how they relate to the Fed. Obviously, we're not going to get a July rate cut, at least deemed by market activity and most economists and analysts. So we want to watch the complexion of the curve. I would say that use 50 basis points as your guide on the difference between 10s and 2s. Becky, back to you.